All right, let's get right into it. Today, we're diving into a story of two accounting methods. And trust me, it's a real rivalry, one that completely shapes how companies report their profits, how much they pay in taxes, and really the whole financial story they tell the world. It is the great showdown, FIFO versus LIFO. So think about this for a second. It sounds completely backward, right? Your business is on fire. You're reporting record profits, but then, bam, you get hit with a massive tax bill that you literally don't have the cash to pay. How does that even happen? Well, that's the big puzzle we're going to crack open today. And the answer all comes down to how you count your beans, or in our case, your muffins. So to understand this, let's first zoom in on a simple bakery's dilemma. For any business that actually makes or sells physical stuff, keeping track of costs is everything. And it gets really tricky really fast when the price of your ingredients is constantly changing. So how do businesses solve this inventory puzzle? Well, let's start with the most popular kid on the block, the most common method out there. FIFO, which stands for first in, first out. Now, the most important word on this slide, the one you've got to lock in on, is assuming. See, FIFO is a rule for how you do the math on paper. It assumes the first things you bought are the first things you sold. It's all about the flow of costs in your accounting books, not necessarily the physical flow of items on your shelf. The perfect way to think about this is milk at the grocery store. You know how they always push the cartons with the soonest expiration dates to the front? That's so they sell the oldest stuff first. Well, FIFO applies that exact same super intuitive logic to a company's finances. Okay, to really see how this plays out, let's pay a visit to the Sunshine Bakery. We're going to follow a couple batches of their muffins and see what happens. So, here's the setup. It's pretty simple. On Monday, it costs the bakery exactly $1 to make each muffin. But by Tuesday, boom, inflation hits their suppliers, and now the cost to make the exact same muffin jumps up to $1.25. Then on Wednesday, they sell 500 of them. And this brings us to the million-dollar question. When the bakery calculates its profit for those Wednesday sales, which cost do they use? Do they use the cheap Monday cost or the more expensive Tuesday cost? Ding, ding, ding! If you guessed the Monday cost, you absolutely nailed it. Under the rules of FIFO, first in, first out, the bakery assumes it's sold that first older batch. So the cost is 500 muffins times that old $1 price, giving them a cost of goods sold of $500. Now this all seems perfectly logical, but here's where the plot thickens. This is where the villain of our story creeps in, inflation. And it's here that FIFO's simple logic can spring a hidden and very, very expensive trap. So here's the absolute heart of the problem. The bakery is selling muffins at today's higher prices, but it's matching that revenue against yesterday's cheaper costs. This mismatch between old costs and new prices makes their profit margin on paper look way, way bigger than it is in reality. And this chart just lays it out so clearly. See that shorter bar? That's the real profit. The profit based on what it actually costs to replace the muffins they just sold. But that taller bar? Whoa, that's the huge inflated paper profit that the FIFO method reports. And look, this isn't some tiny accounting quirk. As the source material puts it, pretty bluntly, FIFO can make it seem like companies are absolutely rolling in dough, when the reality is something else entirely. And here is the punchline. Here's where it all comes crashing down. You don't pay taxes on reality, you pay taxes on what you report to the government. So that bigger paper profit leads directly to a bigger and very, very real tax bill. And that is exactly how a profitable company can suddenly find itself in a major cash crisis. So you're probably thinking, if FIFO has this massive flaw when prices are going up, there has to be another way, right? Well, there is. It's time to introduce its rival, LIFO, the last in, first out method. It was basically invented to solve this exact problem. LIFO just takes the FIFO rulebook and flips it completely on its head. It assumes the newest things you made or bought are the first ones you sell. So going back to our bakery, LIFO would use the more expensive $1.25 muffins as the cost, which does a much better job of matching current cost with current revenue. All right, it's time for the main event. Let's put these two accounting giants head-to-head in a direct showdown and see how they stack up. Okay, let's break this down because the trade-offs are huge. During inflation, FIFO gives you higher reported profits. That looks amazing to investors, might boost your stock price, but it comes with that higher tax bill. LIFO does the opposite. You report lower profits, which doesn't look as flashy, but you get a lower tax bill, and that means more real cash in the bank. Now, when it comes to inventory value on your balance sheet, FIFO is more accurate because it's based on recent costs. LIFO, on the other hand, can leave old, super cheap inventory sitting on the books for decades, making your assets look way less valuable than they are. And here's the kicker. LIFO is basically an American thing. It's banned by international accounting standards, so the rest of the world can't even use it. So, at the end of the day, here's the bottom line. Choosing between these two is a massive strategic decision. FIFO is simple, it's the global standard, and it makes your profits look good. Its big weakness? It can create those phantom paper profits that lead to painful tax bills when inflation is high. LIFO is the inflation fighter. It gives you a real tax advantage, a real cash benefit. But its weaknesses are just as big. It's banned almost everywhere outside the US, and it can make your company's inventory value on paper look seriously misleading. And that really leaves us with one final thought. The next time you see a news headline about a company's blowout earnings, especially in a world where prices are rising, I want you to just pause for a second. Ask yourself, are those profits real, or are they just paper? Is that actual cash performance, or is it just the result of an accounting choice made years ago? The answer might change how you see that company entirely.